Good day to you all. I'm Scotty from Xenium Real Wealth, and this is our August 2019 property market update. So we do one of these every month. It's usually about the second week of every month, and we talk about the activities in the market and the media for the month before, and of course look at the data, look at what it's saying, and see what needs to happen from there. All right, so I will, let's see what we go here. We're going to share a screen, see if we can get this to work. All right, can you guys see my screen now? Okay, all right, that's good. So this month, the RBA kept rates on hold. Nothing particularly amazing about that. It was kind of, you could flip a coin, right? Are they going to keep it on hold? Are they going to drop it? Are they going to do whatever they're going to do? Who knows? But they kept it on hold. Now we're talking, does really 0.25% make a big difference when you're at 1%? Well, in terms of percentages, yeah, like what is it? It's literally 25%. But in terms of it actually changing the affordability for home ownership, that's debatable, right? So that's where that's at. Not a whole heap of news there. It's talking about potential rate cuts of between 0.5% and 0.25% coming towards the end of the year. That's a fairly big deal. But as I said, we don't make those decisions. We just get to talk about them. So that's the result this month from RBA. The rates are on hold. One of the changes that did flow through this month in relation to finance was the APRA assessment rate changes. So they announced at the end of May, early June, and APRA is the Australian Prudential Regulatory Authority, that they were going to change the assessment rate for lending. Now that means that currently up until last month, it was looking about 7 to 7.25% was the rate. So even if the home loan rate was 4%, you would be assessed at 7.25% or 7%, depending on the bank. And that was your assessment rate. So you can see there's a massive difference between actual rates for your loan and what you're assessed at for your serviceability. APRA said they were looking to make changes. They did make changes, and some of the first banks, ANZ and NAB and a few others, Westpac I think, came through and changed them straight away as soon as they're allowed to. Now, you guys can see that. So the major banks tweak the home lending rules. Well, they don't. APRA changed it. What it means is ANZ and Westpac were the first. They changed the floor rate, right, down to 5.5 from 5.75 and increased the buffer. So all that means is that if your home loan rate was 4%, now there's a 2.5% buffer as a minimum that has to go on there. And so that means you'd be assessed at 6.5%. Or if it was lower, say, 3.5%, then you add 2.5%. You get the idea, right? That's how that works. So that makes a really, really large difference. And we'll show you the sort of difference that makes now. So on a 7% assessment rate, now we did up some calcs on this. We're looking at home value. Can you see my cursor up the top there? Yep. Of $650,000. We've got an income into the household of $120,000. That essentially meant a home loan of $570,000 based on that qualifying rate of 7.25. So, okay, fair enough. You could afford that with a 20% deposit, etc., etc. Not changing the value of the asset because it's not really relevant in this. We're just changing the loan criteria. We changed the qualifying rate down at 1.25%, and the loan amount went straight up to $650,000. So it was like a 12% increase for about every 1%, or it was about one a bit percent changing of the assessment rate was up to a 12% plus increase in your borrowing capacity. And this was on this one example. That's not across the board. Obviously, that can vary. The more you earn, the more you're borrowing, all that sort of stuff. So that sort of thing is a very, very large change, especially if you look at, say, a qualifying rate dropping below 5%. You know, we could be pushing 15+%, maybe even 18% in serviceability ability for residential mortgages. Now, that's a massive change. You talk about a 15% change on a $500,000 property, you know, that's a lot of money. You know, we're talking about $75,000. So instead of looking at something for 500 grand, you can go, oh, we can stretch to that 550 because now we're allowed to get the loan for it. We're allowed, you know, the banks will let you get the loan for it. So that's how that assessment rate works. And that's why the assessment rate is even more important than the actual loan rate when you're coming to getting a loan, because it was more influential in that transaction. All right. So the other thing that's happened, because we've had property tank in some places over the past 12 months, tank's a strong word, but you know what I mean. We've had a lot more first homeowner activity. Let's have a look here. In fact, in May, first homeowners were the largest recorded share since 2012, right? So first home buyers accounted for 29% of owner-occupier home loans in May. So that's a fair bit. It's pushing a third. We're close to a third there for first home owner loans in owner-occupier, right? So they've removed the investment component and they're just talking owner-occs. So that's a big deal, right? That's a pretty big deal. So that's all back to with the rate cuts, the lending rules. There's a home loan deposit scheme. Obviously, we don't deal a whole heap with first homeowners, but we always watch the activity because they are a big part of the market. And as you can see, it's up to a third of the owner-occupied market. So they're definitely becoming active again. And in fact, it says here, the affordability of the market is the best it's been in 2 decades, as mortgage repayments take the smallest portion of earnings since 1999. So we're going to party like it's 1999 if you're a first homeowner. All right. So if they have a medium price home, assuming a 10% deposit, mortgage repayments will consume the smallest portion of their earnings. So there you go. All right. So the other thing that happens at this stage in the cycle, so we've seen properties sort of go down in some prices. We see that's good for first homeowners. They get back into the market and they can, you know, there you go, a third of the loans are going to first homeowners. But we see big things like developers go bust. And this happened earlier this month. Raylan, whichever way you want to say it, group. They were a decent size. They only owed $500 million to creditors. So I guess, you know, it's the old story. If you owe 500,000 to a bank, you're in trouble. If you owe 500 million, they're in trouble. And I guess that bank and those creditors are in trouble. So they just collapsed. Raylan was very big in apartments. So is it surprising? I don't know. I don't run Raylan's financials. But the simple fact is that you wouldn't really want to be building apartments for the past 2 years, let alone moving forward for the next 2. So it's not particularly surprising. We always see this sort of thing at this stage in the market cycle, but definitely not a good thing for tradies, for investors, for people that have bought off the plan, which is not something we really ever suggest for an apartment, because those deposits that are gone in there, where are they gone? Are they still in the solicitor's trust account? Were they used as part of there's some schemes out there where they can release the deposit and they're used to help the developer fund the construction. Was that happen? There's all sorts of stories kicking around. All it is that there's $500 million there that's owed to people, and that's not a particularly good thing. So Raylan had a development pipeline of over 3,000 residential units, as well as operating accommodation assets over 600 rooms. So that's a lot of property there. So that's Raylan's story. All right. The other thing that we always look at in our monthly market updates is where we are in the overall property cycle. So I'll find, where are we there? All right. And there's everyone's mate, Philip J. Anderson's clock. So Phil's clock, if you haven't seen it before, you can jump on and we've done some training on that on our vault at xenium.property. So Phil's marked here. So we're in the mid-cycle right now, mid-cycle slowdown, which is 1920. And that's where we move through to the second phase of the real estate cycle. So this time frame here is 19 and 20, where it's a mid-cycle. It's quite tumultuous, and we see these sort of things happen where prices have gone down, enables some people to get back into the market, like first homeowners, and we see bigger companies that can't hold on, or even smaller companies that can't hold on, don't have the cash flow, start disappearing. So it's a bit of a purging time, but it's not the end of the world, and it's not a bad time to get some good buying in the right areas, and we'll come to that a bit later on. All right, go back here. Rightio. Okay, the next one on my screen is some market commentary. So now that we've seen where we are on the property clock, which is, I'll flip back there, that there. So we see we've gone increased building activity, we've gone to a mid-cycle slowdown, and that mini purging, which is down ready for the next full phase of the real estate cycle. So this is a clock that Phil did in 2014-ish, and that's on there then. Let's take a look at this article. And this is from domain.com.au, one of the large real estate aggregator sites in Australia, the middle of last month. So Brisbane is set for the largest price rise of any capital city over the next 3 years. So good for Brisbane. We're 20% jump likely in new forecast predicts. Sydney and Melbourne prices are set to bottom out and rise at a modest pace. And these guys are suggesting that's coming down around 2019 to 2020, and later on in the report to 22. So this report here is lining up very, very closely to what Phil's clock has said, which he designed 5+ years ago. But it's talking about, obviously, it also aptly demonstrates that we don't have an overall Australian cycle. There's a macro cycle, but the property markets are very specific. You can see that here, that Brisbane is set for a rise, and Sydney and Melbourne are set to bottom out and then rise. So it's very, very interesting. Obviously, this can be data, can be opinions, can be all sorts. I'm just talking about what's out in the media right now. We'll get to some actual data later on. So it goes on there. We've got growth from 2019 to 22. We've got 6%, 7% from Melbourne, 20% Brisbane, Adelaide, Perth, 7%. So everything is actually pegged for a growth in that time period, which is interesting because 4-6 weeks ago, all we were hearing was doom and gloom. So it's actually very, very interesting. We have seen the Sydney and Melbourne markets, Sydney falling 18%, Melbourne 15% from their peak. So if you are looking at buying in those areas, you can be guaranteed that you're not buying at the peak, which is always a good time to not buy. I'm not saying it's a great time to buy right now, but you're definitely guaranteed that you're not buying at the peak in those areas. And as it says there, Brisbane is looking at 20%. All right, so we'll go over here. Our next set of commentary says the worst of the property downturn is over. So for every article that you can find on doom and gloom, you can find one of hope and everything is prosperous. So I'm just trying to weed through some of this with us tonight. It's this one I've called up because it's more on sentiment rather than actual sort of data. And that's really, we can look at data, and data is important, and data is what drives our decisions, but sentiment is helpful when we come to sell a property, right? Or data is what has actually happened, whereas sentiment is that hope and that feeling, or in the reverse is the doom and gloom. So sentiment is really important to consider when you're looking at the data as well. So we're looking here, consumers believe it's the best time to buy a dwelling since February 2015. So that's despite confidence seeking sinking to a 2-year low. So that means that people are hesitant to buy, but they're actually seeing that prices are good and it's actually not a bad time to buy. Now, I've noticed specifically in probably the past 2 to 3 weeks that a whole bunch of media has changed coming out. So we were doom and gloom till really the end of the financial year, and then as we went into July, things started changing, and now it's like, oh, have we found the floor? Have we done this? Have we done that? So we've got a time to buy dwelling index here on points. So you can see that it's dropped down as prices. It's going to be inverse to pricing. So as pricing's high, the gut feel to buy a dwelling drops. We're not talking about hype here. We're talking about sort of home owning sort of stuff. The sentiment goes down, and then that was pretty much the peak, right? You can see my cursor there, and then it goes back up again as prices, drop. So it's an inverse to pricing. So that's a pretty interesting report there. All right, next one we've got is Australia's housing bust is coming to an end. Yeah, I'm not really going to read through this. I was more interested in the charts. Okay, so we've had price movements. We've actually had some price changes there in June 2019, and we've still had some other movements downwards here. So let's look at the amalgamated monthly price movements, which is this chart. So this is, you can see my cursor. So it went right down, right, drop as an average. It's an amalgamated average, and the dropping has been less. And so it's not to look at and say, well, has the dropping stopped? You're looking at trends here, right? So we see a trends down, and now we're seeing trends back up. And the 5 city, same thing, right, down and back up. And that's important because because data is always behind the times, right? Especially with property, it's not daily price like shares. It's transactionally priced, which could be once every 7 years, perhaps as an average. Then that's really slow to get that data come out of there. So we've got to watch for those trends. All right, what else we got here? Light at the end of the tunnel. This one I called up because it was a PRD, which is a real estate firm report. So, they're good and bad because they get real reports and data from their transactions, and they can be bad because they're real estate firms. So how they're going to, sway that. But essentially, they're the same thing. They're saying there's a softening in median house price, with prices dropping there and there on those reports. We've got a healthy, this is why I got this one, a healthy rental return. So this is the other thing to look at when we're looking at investing. So we've got an average national vacancy rate there of 2.2%, which is just exceptionally low. Whereas the benchmark, what they'd call the balanced rental market, is 3%. So that's a really large amount of difference there. We've got 0.8% on a 3% as a balance. So we're talking about possibly an undersupply of rentals in some areas if you average that out. So that's pretty interesting there. All right, and I think this might be the last one. Is the property market downturn finally over? Who knows? You got to love these questions they ask as headlines. Are we supposed to answer? Do we reply in the comments? Yes, no, maybe. So the longest and deepest fall in national house values in more than half a century appears to have ended, right? So this is based on CoreLogic's house values. So they inched up 0.1% across the nation's capitals as an average through July. So Sydney rose 0.2, Melbourne 0.1, and apartments did whatever. Don't really care, It's the second consecutive monthly lift for the nation's 2 largest property markets, right? So that is pretty good. And it says here they still have house values close to 50% higher than at the start of the decade. So it's still way up from where it was. All right. So that's that data there. Now, the next section that we talk about for the next few minutes is the HTW report, month in review. So let's start doing that. Okay, so this is the HTW report. You can get this for free. Jump on to htw.com.au, I think it is. Perhaps we will see in this report. Jason or Karen, if you know what that email address is, can you chuck it in the side for everyone to be able to jump on? All right, let's skip straight through this. We'll look at, that's retail. And we want the orange clock. You gotta love a 90-page report. Okay, here we go. National property clock for houses. Okay, so once again, the orange wording, the towns that are in orange wording, they are different from last month. That's all that means. It just means that they have had a change from last month. So this is the HTW clock. We see down here, this is the declining market. So Gold Coast last month was up, starting to decline. It's declining now. Those guys haven't changed. Kalgoorlie, Newcastle, etc. We go around here. Southern Highlands, Sydney is approaching bottom of the market, which is lining up with all the data that we've just read through, right? All that data is approaching bottom of the market for Sydney, and Melbourne, bottom of the market. It actually says Brisbane is bottom of the market. Rockhampton, Toowoomba, a lot of Queensland sort of stuff in there. Bundy, and then we've got Ipswich, and then we've got Alice Springs, Darwin in there as well as Melbourne and Perth. Starting a recovery over here, some Queensland towns. Mackay, as we talked about last month, and we might talk about that again next week. Port Hedland, those guys haven't changed. Adelaide Hills, etc., they haven't changed. Hobart is still approaching peak. It hasn't moved since last month, but I'd be very cautious of there because it just depends on what you're buying and that sort of thing. That would probably be looking at, if we're doing development in Hobart, which we're not, we would be looking to do no more because our compass would tell us that. And yeah, that's it. So that's really the nutshell version there of the HTW clock. I need to now show you, where are we over here? So let's pick some clock data points there, and we'll say, well, Brisbane's at the bottom, Gold Coast declining, Newcastle, and what's going up? Mackay rising, and Hobart's approaching peak. All right, so we'll go and look what to do. Yes, I'll stop that and go back here. All right, so you guys can see our compass. So our compass there, we take the data points from HTW and put it on ZAC, our Xenium action compass. So you can see over this section here, Gold Coast and all that, remember, sitting over that side, falling market. We've got down here, Brisbane, Melbourne, other bits and pieces. So we're looking for positive cash and potentially some land banking or buying with some upside. And over here, we've got Mackay and a few others, Cairns and other bits and pieces, where we look to do some small projects, potentially in development over there. You can do development from the larger towns here because they'll carry through. But yeah, you don't do development on this side, residential development on this side of the fence. So that's how the compass works there. And then we take the data points from HTW on that one and put it on our compass. So to me, there hasn't been a whole heap of changes. Gold Coast has dropped from last month to this month on the HTW clock, and Melbourne's solidified down the bottom. Sydney has moved around a little bit, approaching the bottom of the market. So they're probably the key ones that we're looking at in this area. When Sydney looks like it approaches the bottom of the market, it also has the highest runs. So when it swings back up, so we need to watch that, because if Sydney does start on a run again, it's going to be a big one next time. Like it had a good one last time, and there's no reason why, if confidence comes back and that sentiment's there, that Sydney won't have an absolute cracker as next phase of the cycle. All right, what else have we got? Have we got any questions? All right, property projections in Rockhampton. Perfect timing for questions. Thank you very much. Okay, Rocky sat over here on the HCW clock. We have clients with property in Rocky. I've got a good mate who runs an agency in Rocky, and he contacted me about 4 months ago and said, I think it's at the bottom. You guys should look at getting back in. So what we're seeing now is the data that is substantiating his comments there. Rocky is not a one-trick pony in the sense it's not just a mining town. It does have ag, like especially beef and other bits and pieces. Not so much tourism. There's a little bit, but it's not like some other places. I would only be chasing either highly discounted property that you're getting at a really good price, or something that was really, really positive cash flow in Rocky. That's what I'd be looking at. That'd be the only two things there. I wouldn't be comfortable doing a development in Rocky. I don't think the fundamentals are there enough for us, especially when there's still a lot of positive cash flow property on the market, like 3-4 pack units, things like that you can go and get. And there's some really good discounted properties. So it's not a no. It's just be cautious of what you get. Any other questions we got about that? The clocks, the cycles. Okay, Toowoomba currently at the bottom of the market. Yeah. So Toowoomba benefited from the range bypass and also the airport, which is a private airport from Wagner's out there. That airport has been going absolute gangbusters. Toowoomba had a big run up into, what are we in, 16, I think. Karen, we were working in Toowoomba. So from, say, 13 to 16, we were working pretty heavily in Toowoomba, and a lot of clients made a lot of money. We're reassessing Toowoomba at the moment. My contacts on the ground earlier in the year said it looks like same thing, that it's bottomed out, and we're currently assessing financials on projects there like duplexes and things. We'll get back to you on that, but it's definitely on the look list. Toowoomba is on our look list for sure. If there's no other questions on anything, feel free, if there's other questions, jump on. If not, I've got one last article to show us, and then we'll call it a night, because we're 3 minutes from being half an hour, and I like keeping these things on time. So if you've got any more questions, punch them in the side. But at the moment, I'll go through this one here. All right, so this is a left field article that just is really demonstrating the way that the property cycles work. This is actually Pakistan, right? We're not looking to buy in Pakistan, so don't get the wrong idea. But this article here talks about Pakistan's property boom. And what's happening is developers are going in, they're grabbing tracts of land. Literally, they are going in with bulldozers at midnight and pushing people out of the way. You're talking about camps and, say, the poor people. They're then paying off regulators and then getting capital, and they're literally putting signs on saying new development here, buy a condo, or whatever they call it in Pakistan, and away they go. What's happened is that we're looking at, look at some prices here, right? So a 300 square yard plot, this is in US dollars, over $1.3 million. I mean, this is the sort of stuff that goes on in the property cycle, right? There's a land. What happened is those poor people would be living and close to infrastructure and services in near the cities and what have you, and someone just goes in the dead of night, bulldozes them out, and acquires the land. Now, I'm not saying we can do that in Australia or that we'd even want to do that. I think it's absolutely horrible. But I'm showing you this article because it's proving the way the property cycle works. Because all it is that those gains that are sitting there waiting in the land to be happened, from realising it, capitalising on it through putting property construction on it, reselling it, land banking, whatever it is they're doing. And it says here, people who buy these plots aren't building houses, they're holding on to them so they can sell one plot and buy two others elsewhere. So it's pure speculation. We're seeing speculation in this area. Now, why is this important to us? Because we see this sort of stuff happen in certain markets. Someone will say there's a new, there's an announcement of a new rail line, a rail station, and all of a sudden, property gets disappeared in that area. If you really want to know what's going on, I would suggest we try and somehow work on looking at how to keep a track of what federal members of parliament, state members of parliament, and councillors, local councillors are buying in their property portfolio, where they're buying, because I guarantee you in between 2 to 5 years, those sorts of lands are going to be rezoned, and we have massive uplift. And because we see it all the time. We've seen it especially recently down in Ipswich and Caboolture. So that's in southeast Queensland. Those two, there's lots of land parcels, and people are buying things for average pricing, and all of a sudden they were rural, and then they're rezoned as residential. And this is essentially what they're doing by force in Pakistan. But we see it done a little bit more on political handouts in Australia. All right, I'm going to stop sharing this screen now. And before I go, I always talk about a couple of books that we're reading. So there's this one here. It's the one that you should all get. It's pretty much the Cycle Bible by Philip Anderson, Secret Life of Real Estate and Banking. Go and get that from Amazon or Booktopia or something. You can see mine's pretty tattered because, it gets used a fair bit. But the book I've just finished reading last month is this one here, Rethinking the Economics of Land and Housing. It's not a bad read if you're into that sort of thing. It's pretty in-depth. It's written by some UK guys. There's some fantastic examples in there of land cycle gains in the UK from infrastructure, ways to try and capture it, why that probably won't ever work, and why that you can capture it privately through a government granted license, which is owning a parcel of land. So that is a really good book, and I'd suggest you jump on and get that one as well. All right, if you missed our last week's webinar, that was with Rachel Hambling, Development Site Acquisition Specialist. Check our Xenium Vault for that. It was really good. She talked about finding development sites and how to letterbox drop and what tools to use and things like that. And next Thursday night is our monthly Propportunities update. So we're going to assess all this data that we've gone through now, and we're going to come back and bring you the best opportunities in Australia that line up with the market cycles and where things are at this point in time. So stay tuned for that one. You'll be getting an email on that in Monday, Tuesday next week. All right, that's enough from me, Scotty from Xenium Real Wealth. This is our August property market update, where we assess the data, the trends, and look at the places to look at and the places to avoid. All right, that's it from me. Hope you've enjoyed it, and I'll talk to you soon.